Traders and investors, what if I told you that beating the market doesn't require hours of screen time, complicated systems, or even indicators? I say 15 minutes per week because this strategy trades on weekly bars. That means you need to wait for the close on Friday to take a decision to trade this strategy. I know this is crazy because all YouTubers are pushing to trade 1 minute and 2 minutes and 5 minutes. So weekly seems like an eternity, but we want to make money, so who cares what time frame we use? Now, it is not a secret that all US indexes and some international country ETFs are all mean reverting on the long side. That means if you are trading on the long side waiting for a pullback, you usually make good money. And this strategy exploits that phenomenon. Now, I recently featured this strategy in my Algo Trader newsletter, and I used the futures in that version. But in this video, I will show you how it works on the ETFs. So this is the strategy that we are going to implement. Like I mentioned, you don't need any special platform to execute this strategy. So this is the strategy logic. Let's forget about the strategy filter for now. Remember, we are executing this on weekly bars. So every Friday after the close, we check if the close is lower than the previous close. That means this Friday, you check the close if it's lower than the close of the previous Friday. If it is lower, then we take a position long and we exit next bar, which is next Friday. So that means we are holding for one weekly bar. And if the close is not lower, then we wait for the next Friday. Now, the strategy results were amazing on the S&P 500, NASDAQ, and the Dow Jones. But in this video, we will test it on ETFs. Now, ETFs have longer historical data, so let's see if that makes a difference. Also, with ETFs, we cannot trade a fixed position. So in futures, we can trade a simple contract, one contract. That contract is already leveraged, and we can use fixed contract over all the past years. With ETFs and the same thing with stocks, you need to divide the whole account per the close to get the maximum number of shares. This is the only way that you make it equal. Because if you take, for example, splits or reverse splits, then that will wreak havoc on your strategy. So remember always, when testing on ETFs, to use the full account value to buy the maximum number of shares. So here are some examples of the trades. Here the close is lower than the previous close, so we buy, and then we exit on the next close. Now here the next close, again, the close is lower than the previous close, so we buy and we exit on the next close. So in theory, you could have held only this close all the way here, or you could have added another position here. But in my test, I'm assuming that every trade is independent. So here I take this trade, I lose money, I take this trade, I win money. In fact, every losing trade, in theory, it's another position to add. Because to lose money, the close has to be lower than the previous close, which of course it's another entry. Either way, this video is about simplicity, so I will assume that we will exit every week. This is the equity curve for this strategy on the S&P 500 ETF with the symbol SPY. Now, data here, I have it since 1996. And here I have the buy and hold on the right side and our strategy on the left side. Now, at first glance, you might think they are the same. So let's look at the numbers. You can see the buy and hold. So if you bought in 1996, $35,000 worth of SPY shares, held it all the way up to 2025 in April, you end up with $231,000. And if you trade this strategy on weekly, you will make $246,000. The return to drawdown here is 3.7, here is 4.1. So they look very close, but they're actually extremely different. So obviously the buy and hold is 100% invested in the market. But our strategy is only 44% invested in the market. So half of the time we are not in the market. And looking at the periodical return, this is the buy and hold on the right side. And 2000 to 2002, that's the dot-com bubble. 2008, subprime crisis. 2011, Europe crisis, same as 2015. 2018 and 2022 was a down year. Also, 2025 is a down year. Compared to our strategy, which is making slightly more money and half the time it's not in the market, we have only 2002 a down year, 2008 same down year, and this year 13 compared to 8. So overall, this is a much better return per year. Also, we can see that on the S&P 500 buy and hold, there is a stagnation period between 2000 till 2014. That means for 14 years, your money didn't do anything. Here we have about 6 years. So from 2002 to 2006, and again from 2008 to 2012. So simplicity at its best. There is no indicator here. There is nothing actually. You're just looking at the close on every weekend, which is extremely simple to do in any platform. And half of the time you are not in the market and the other half you are in. You are beating buy and hold for the last 28 years, and you have more profitable years. Plus, you have better return to drawdown. So you beat buy and hold on every metric. Plus, you don't need to watch any chart or watch the news or anything. The backtest has been through all the crises. There is no optimization. But of course, like any strategy, we can enhance it by adding a filter. And this strategy is no different. Okay, so here are the results. So this is buy and hold, and this is our weekly strategy. And this is exactly the same strategy, but now I added a filter. Again, they seem very close, but they are not. So looking at the statistics, this is 231,000 in returns, 246,000, and this is 360. Remember, they're all starting with $35,000. Return to drawdown, 3.7, 4.1, 4.3. So return to drawdown is not that big. And also, if I show you the time, so the exposure here is 44, and the exposure here is 40. Of course, the exposure in buy and hold is 100%. So this makes a huge difference if we take that into consideration. And here is the metric I use. If you divide the return by the exposure by the historical data length, you get this number. So the buy and hold is basically making 8,000 per year. And if we take the exposure of our strategy, then we are making 19,000 per year, even though they both make about $240,000. Now, our strategy with the filter already makes more money, but also lower exposure. So that makes it at $31,000. So the difference between now this strategy and the buy and hold is almost 4 times. Not only that, our strategy with the filter now is much, much better. So the biggest drop is in 2022, and recently in 2015, we are also a little bit down. In my Algo Trader newsletter, I featured the volume oscillator as a filter for the strategy. Now, I use that filter for the Dow Jones, NASDAQ, and the S&P 500, and they all worked beautifully. On the ETF, I used the volume oscillator plus a volatility filter. And as you can see, the results are beautiful. Now, I also wanted to test other markets using the ETFs. So I removed the filter, kept only the simple rules, which is close on Friday, lower than the previous close on previous Friday. We go long, we exit after 1 week. So here is the portfolio I used. Now, these are the US indexes, some sectors, some global stock indexes. Honestly, I don't know the bottom half. I just copied 25 ETFs, put it in, and only kept the ones that were doing well. As you can see, we are using a weekly time frame since 1993. And here are the results. So the SPY is making 246,000. Remember, we are not using the filter in the strategy. This is the basic weekly strategy. And all of them are doing really well. All of them doing also good with number of trades. The correlations are very high, which is highly expected because all these are based on stocks. So of course, this is not about trading all these symbols, but it's just to show you that the strategy extremely simple. And because mean reversion works on most indexes, I'm just showing you that yes, it does work on most indexes. Still, you can pick maybe the top 3 least correlated symbols from this list and use it as a one strategy. So now you've got a weekly ETF strategy that is so simple, it's almost unfair. It only takes 15 minutes per week and it works on multiple markets without any indicators and any platform. If you like this breakdown, then you will love the next one.